In the summer of 1929, a California man known to his friends as Champagne Fred was living precisely the life his nickname suggested. Fred Bell had inherited money, invested it in the stock market during the great bull run of the 20s, and watched it multiply. He dressed well, he spent freely. He was, by every visible measure, a man at the peak of the modern American dream. 2 years later, on the 7th of March 1931, a photographer found him on a street corner in San Francisco. Fred Bell was wearing the same three-piece suit. He still carried a cane, but the man standing behind a wooden apple stand, selling fruit for a few cents apiece to passers-by who would not meet his eyes, was not a wealthy man. He was a broke one. The stock market crash had taken everything he had. The photograph became one of the defining images of the Great Depression. Not because Fred Bell was unusual, because he was not. Between September 1929 and July 1932, the Dow Jones Industrial Average fell from its peak of 381.17 points to 41.22, a collapse of 89%. 9,000 banks failed. Unemployment reached 25%. Industrial production fell by nearly half, and the mechanism that produced this catastrophe, leveraged speculation built on borrowed money, extended far beyond any system's capacity to absorb a reversal, had been visible to anyone willing to look. Some looked, most did not, and the distance between those two groups is the story this episode will tell. Two men defined the weeks before the collapse, and they pulled in opposite directions. The first was Roger Babson, an economist from Massachusetts who had spent years warning that the market was detached from economic reality. On the 5th of September 1929, he stood before the annual National Business Conference and stated plainly, "Sooner or later, a crash is coming, and it may be terrific." The Dow fell 10 points that afternoon. Financial journalists mocked him. The episode was called the Babson Break, as if the market's reaction to his warning was itself proof of his foolishness. The second man was Irving Fisher, professor of economics at Yale, one of the most celebrated financial minds in the country. 13 days after Babson's warning, Fisher published his response in the New York Times. Stock prices, he wrote, had reached what looks like a permanently high plateau. The crash was not coming. The system was sound. Fisher had his own substantial stock portfolio, and he believed in it utterly. Within a year, Fisher had lost the equivalent of several $1 million in today's money. He spent the rest of his life in debt, borrowing money from his sister-in-law, and died in 1947 with liabilities that exceeded his assets. The permanently high plateau had taken him with it. Babson was right, Fisher was wrong, and the institutional consensus that dismissed one and celebrated the other is not a curiosity of 1929. It is a pattern that has repeated itself every time a financial system has approached collapse since. Before we go further, if this kind of history matters to you, consider subscribing to the channel. Every video here is built around the financial decisions that actually change the world, the crises, the policy failures, the moments when the system revealed what it was designed to protect. If that is the kind of analysis you want to keep watching, the subscribe button is how you tell us, and we want to hear from you. Did you live through one of these turning points? The 2008 collapse? The 70s oil shock? The end of Bretton Woods? Did it change your family's circumstances? Your understanding of how money actually works? Leave it in the comments. The most complete record of these events is not in any official report. It is in the people who were paying attention. By August 1929, total broker loans in the United States had reached $8.5 billion. That figure was larger than the entire currency supply in the country. Americans had borrowed more money to buy shares than all the money in circulation combined. The structure beneath every transaction was identical. A speculator bought shares on margin, putting up perhaps 10% of the purchase price and borrowing the rest from a broker. The broker borrowed that money from a bank. The bank had extended credit against the rising value of the very shares being purchased. The entire system was collateral, built on collateral. Every position was leveraged against a price that was assumed to keep rising. The Federal Reserve had watched this accumulation with growing anxiety. In August 1929, It raised the discount rate to 6%, its highest level in years, in an attempt to reduce speculative lending. The instrument was wrong, and the timing was late. What it slowed was not the market. What it slowed was the broader economy. Industrial production had already been contracting since the summer of 1929, whilst share prices continued to climb. The market and the economy had separated entirely. On the morning of Thursday, the 24th of October, with no single piece of news to explain it, the selling began. 12.9 million shares changed hands, 3 times the daily average for that year. By midday, the market had fallen 9%. The ticker tape ran so far behind actual trades that brokers could not identify the prices their orders were executing at. A margin call required an investor to deposit additional funds or sell. Those who could not find funds sold. Selling drove prices lower. Lower prices triggered more margin calls. The mechanism was not complicated. It was a chain, and once the first link broke, the rest followed with mathematical precision. At midday on Thursday, 5 of the most powerful private bankers in America gathered in the offices of J.P. Morgan and Company at the corner of Broad and Wall Streets. Thomas Lamont, the bank's senior partner, chaired the meeting. Around him sat the heads of Chase National Bank, National City Bank, Bankers Trust, and Guarantee Trust. Together they pooled $130 million and dispatched Richard Whitney, vice president of the New York Stock Exchange, to the trading floor with a single instruction: buy. Whitney walked to the post where United States Steel was traded and placed a bid of $205 per share, a price well above market, for 25,000 shares. He then placed similar bids on other blue-chip stocks. The gesture was a demonstration of force. Organized capital was signaling that it stood behind the market. It worked. The Dow closed down only 6 points that day. Lamont told reporters there had been a little distress selling. President Hoover announced that the fundamental business of the country was sound. The following Monday, the Dow fell 12.8%. There was no second intervention. The bankers had spent $130 million and purchased 4 days. On Tuesday, the 29th of October, 16.4 million shares traded, a volume the exchange had never approached before. Some stocks found no buyers at any price. Around $14 billion of share value was destroyed in a single session. At the Morgan offices that evening, Lamont wrote in his diary that the situation was one of the most dramatic he had witnessed in 30 years of finance. He did not record what he thought it would cost the people who were not in that room. When Black Tuesday arrived, 2 men occupied opposite ends of what it meant. Jesse Livermore had seen it coming. In early 1929, whilst every institution in America was calling for continued gains, Livermore had been quietly building a short position, betting the market would fall. He used more than 100 separate stockbrokers to conceal the scale of what he was doing. By spring, he was down $6 million on paper. He did not close his positions. On the 29th of October, when 16 million shares sold in a single session, his short positions paid. By the end of that week, Livermore had made approximately $100 million. The newspapers called him the Great Bear of Wall Street. He received death threats. He hired an armed bodyguard. His story did not end there. By 1934, the $100 million was gone. In November 1940, he walked into the cloakroom of the Sherry Netherland Hotel in Manhattan and shot himself dead. The man who read the pattern correctly could not survive the world that pattern had created. Wellington Lytle did not read the pattern at all. He was not a speculator. He was an ordinary man who had trusted the system as ordinary people were advised to do. After the crash, he found himself in a Milwaukee hotel room with 4 cents remaining to his name. Before he put a revolver to his head, he took out a pen and left a note. It read, "My body should go to science, my soul to Andrew W. Mellon, and sympathy to my creditors." Mellon was the Secretary of the Treasury, the man who had told Americans the market was sound. Lytle's note was darkly precise. It assigned his physical remains to the institution of learning that might benefit from studying him. It assigned his soul to the man whose assurances had helped keep him in the market. and it reserved only his sympathy for the people he owed money to. He had 4 cents, and he was still thinking about what he owed others. The market crash was not the depression. It was the trigger. Between 1929 and 1933, 9,000 of America's 25,000 banks failed. In Detroit, the collapse of 2 of the city's largest banking institutions in February 1933 forced Michigan's governor to declare an 8-day banking holiday, the event that precipitated the national banking crisis. Factories that had been producing automobiles for export to the world now stood silent. Unemployment in Detroit reached 30%. In Chicago, the city's banking system had been weakened by years of connections between banks and speculative real estate ventures. When depositors began withdrawing cash, the cascade ran through institutions that had been lending to each other and could not stop it. Savings that families had accumulated over decades, savings held not in shares but in ordinary deposit accounts, disappeared with the banks that held them. The Federal Reserve, created in 1913 to prevent precisely this kind of systemic collapse, did not intervene as a lender of last resort. It allowed the money supply to contract by 1/3 across 4 years. Ben Bernanke, in a speech given at Milton Friedman's 90th birthday in 2002, acknowledged what this meant. "We did it," he said. "We're very sorry." The collapse did not stop at American borders. Germany, dependent on American loans throughout the 20s, saw unemployment rise to nearly 30% by 1932. The economic catastrophe did not remain economic. The savings of the German middle class, the same class that had rebuilt modest stability after the hyperinflation of the early 20s, were destroyed a second time in a decade. The conditions produced by that destruction gave political extremism the constituency it required. By January 1933, Adolf Hitler had been appointed Chancellor. The crash of 1929 did not cause the Second World War, but it prepared the ground. Franklin Roosevelt was inaugurated on the 4th of March 1933. The same morning, the American banking system effectively stopped functioning. His first act as president was to declare a national banking holiday. His second was to demand legislation that would ensure it could never happen the same way again. The Banking Act of 1933, known as Glass-Steagall, separated commercial banking from investment banking with a legal wall. A bank that held ordinary depositors' savings could no longer use those savings to speculate in financial markets. The function that had made the crash possible, the flow of ordinary savings into leveraged securities markets, was prohibited by law. The Federal Deposit Insurance Corporation was established. For the first time in American history, a depositor's savings were backed by the full faith of the federal government. Bank runs became structurally impossible. When your savings are guaranteed by the state, you have no reason to queue. The Securities and Exchange Commission was created to regulate markets, require disclosure, and prosecute fraud. The pooled accounts, the hidden conflicts of interest, the practices that had allowed Wall Street to direct public savings into a speculative machine, these were made illegal. These reforms held for 75 years. 9,000 banks had failed in the Depression. Not one systemically failed in the decades that followed. Then, in 1999, Glass-Steagall was repealed. In September 2008, Lehman Brothers filed for bankruptcy. The mechanism was different in its instruments: mortgage-backed securities, credit default swaps, derivatives built on derivatives, but the structure was identical. Collateral built on collateral. Leverage extended beyond any capacity to absorb a reversal, a regulatory boundary that had been systematically removed. Roger Babson had described the pattern in September 1929. Every element of his description was present in 2008. The Dow Jones Industrial Average did not return to its September 1929 peak until November 1954. 25 years. The question this channel will keep examining is not whether the pattern repeats. The record is unambiguous. The question is whether the institutions designed to prevent repetition remain intact when the next peak arrives. In 1929, those institutions did not exist. In 1999, they were removed. In 2008, the world discovered what that costs. If this account has given you a clearer understanding of how financial power actually operates, subscribe to the channel There are more crises, more decisions, more turning points still to document. And if this period of history connects to something you lived through or something a family member witnessed, the bank runs, the inflation, the austerity, the moment a system everyone trusted stopped working, tell us in the comments. What did they see? What did it cost them? What did they believe afterwards? The official version of these events is always written by the institutions that survived them. The fuller version belongs to the people who did not.